everybody. This is Dan Sheridan. A beautiful morning, Monday, January 23rd. And let's look at maybe some opportunities that might be presenting themselves this week. First of all, as we look overall at the SPX here, and this is just a chart on Thinkorswim TD Ameritrade, and you could see last week a few big candles, a little bit of market volatility, but overall we've been in a bit of a range the last 6 weeks from the 3,800 level up near a little bit over the 4,000 level, and VIX is relatively on the low end, under 20. What's going on this week? There's a few things going on this week's. The big thing is just some earnings stuff. You have Microsoft, you have Tesla, you have IBM, some of the defense stocks today. Obviously, they're making some money. But next week is the big kahuna. As they say, you've got the CPI. I don't know if it's CPI, PPI, or a lot of these CPs. So I think it's the CPI, but the big one next week is the Fed. Are they going to raise the rate, a quarter and say, we've got this sucker under control, inflation? Are they going to raise it 50 cents? But I think next week is a lot going on. You got a lot of your big earnings ones, Apple and others next week. You also have Microsoft this week, but a lot of your big earnings ones next week. You've got the Fed, what they're going to do with the interest rate, and then the CPI. So next week's a big one. And I would probably tweak my trading accordingly. In terms of, and we'll see, is this a bear market rally here, or is this legit? In terms of some of the moving averages here. Let me look before we jump into a trade here. We're above the 50-day moving average of 39.32. The 200-day moving average is 39.66. We're above that. We're above most of the moving average averages. But again, I don't see the market getting too much ahead of itself until we get some, especially in lieu of next week with the big stuff. This week, I think it'll be driven by some of your earnings stuff, Tesla, Microsoft, IBM. So this week in our same day class, I plan on putting trades on. We have a class on Mondays and Wednesdays, and I would put a trade on next week. I think would be I'd be much more selective, depending. Probably not next week with a lot of the same day, just because there's stuff coming on almost every day next week. But there may be a day I would, but next week's going to be much more concerning to put on a same day or 1 day trade. As I'm looking at trades right now, if I had to pick one trade right now, it's good to see GLD coming down a little bit. We've been kind of trading that from the bullish position, led by Mark Fenton, who's kind of been bullish on that for a while, since towards the end of the year. He said cyclically, a lot of times it goes up, but because it's run up so much, wanted to see a little bit down. So at least you're getting a little bit down today. I don't think this is enough. In terms of a trade, what one trade in SPX would I probably look at today? And again, with some of the earnings stuff, and let me see here. We've got SPX right now up 24 points, bumping on the door of 4,000. We have VIX. VIX is almost 20, still in the lower range of the VIX over the last 6 weeks or so. The range has been like 18, 19 to 25, 26. So we're in the lower end of the range. Let me I mean, there's a couple different things. I think I'm going to look at today a double diagonal. We look at butterflies a lot, and I would definitely do one, but I think a double diagonal, kind of an iron condor when volatilities are low, right? And when VIX is in the lower end of the 6-week range, I would favor double diagonals, which is a graph, as you'll see in a second, very similar to an iron condor. So I'll give you a quick example of something. And again, because a few bumps in the road on the next week, this week and next week particularly, I want to be out at least, I would say, 3 weeks from this coming Friday. So this coming Friday is the 27th. So I want to go out at least 3 weeks from this Friday. Well, let's just see what that is. 1, 2, 3, like the 17th. So if I go to Feb 17th, use a weekly, that's 25 days out. So I'll give you an example of what I'm looking at. Double diagonal, which is basically an iron condor alternative when the option volatilities are low. It's got the same foundation. You're selling a short strangle. I will give you an example of it. I think we have a class on it. You could check the online, go to our website, Sheridan Mentoring, check out the online classes, and there may be, I'm sure we've done one in the last year on this, but let me give you an example of one. So around 3,900 by double diagonal. And so here we're going to sell Feb 17, and it's a mixed month spread. So I'll buy my long options 5 to 7 days further out. So let me get my expirations first. So if I'm selling Feb 17, I'm going to buy the Feb 22 or Feb 24. It'll be a little more expensive if you go to Feb 24. Let's go to Feb 22. That'll be 5 days between the long and the short. You could go 7 days. Let's go 7 days between the long and the short. It'll be a little more expensive. That's okay. So I'm going to sell the Feb 17, buy the Feb 24. Okay. So this is a mixed month spread. Now, what strikes do I do? All right, let me construct this. So I look at the Feb 17, and on the Feb 17, we're at about 4,000, right? So I'm going to go about 100 points down to 3,900 and sell a put, right? I'm going to go 100 points down from the current price and sell a put. So the Feb 17, 3,900. And then in my other short option, again, very similar to an iron condor, in the foundation, selling out of the money call and an out of the money put to get probabilities in our favor, or we get time decay. So on the call side, I'm going to go, let's see, about 100 points up. Let's go sell the 4,100 calls. All right, so that's the foundation of a double diagonal, like an iron condor, selling out of the money call and put. Then what I'm going to do on the upside, I'm going to go to Feb 24, and I'm going to buy my long call 15 points up. And on the put side, I'm going to go out of the money and buy my put 20 points out of the money. So that would be 38.80. Now, when you see this not traded, what does that mean? It just means that there's some strike here that isn't trading in one of these expirations. That's all. So I may have to tweak it until it says not traded, because it just doesn't, it may be missing one of the strikes that I'd like to do, right? So I think, let me try something. Okay, that will do it. Let me make this, because there's so much room on this trade. So here's the underlying 4,000. That's where we're at. I'm selling the 4,100 calls. I'm selling the 3,900 puts. That's called a short strangle, out of the money put and call. And I'm buying my wings on the upside, out of the money in the further out duration at 41.20, out of the money option, buying my out of the money puts at 38.80 in the Feb 24 further out expiration. And you could see, hey, Dan, that looks like an iron condor. Yeah, that's why. The position deltas are relatively flat. This is your graph at expiration. This is your graph today. And this would be a relatively non-directional trade, something that I would do when VIX is in the lower end of the last 6 weeks. So maybe I just wanted to introduce you to this trade today. Check out our website, Sheridan Mentoring, and have a nice day. And take a little more look at the double diagonal. Thank you.